but let's assume that you did, stick with the indicators and the indicators that were pointing down, and you had the predicted exponential moving average. This blue line has made a crossover right here on this day right here. All of these things kind of favor the fact that this is a time to go short, even with all those type of conditions. And in this case, you had to ride it through this crop report day on September the 12th. Fortunately, it's on your side. Not always does it work out that way, but you want to ride it. Then, if the market does move up, you're going to keep your stops $3 above, consistently above that predicted high. If it's above this predicted high in the $3 range above that as your exit point to get out if the market decides to turn around. If you're doing this strategy and you follow it through all the way, you got the current stop at the predicted high at the predicted high on the current day today, September 29th. Here is 330 or 323.50. $3 above that, you would be out at 326.50. So as long as that market's going down, we don't mind that our little swing trading strategy that we initially started out with has now turned into a trend trading strategy. That's fine as long as it's going in our favor. But we have a couple of warning signs. We have the turn in the predicted differences. They're starting to go sideways. They haven't turned yet, so it's premature to say they're going to move. We don't try to predict when they're going to happen. We have a series of candles that are black and down, and you know that doesn't go on forever, at least if you're familiar with today's market. So some things say that this may be a time for caution, so that's why we want to make sure that we have our stop in place to exit with the most profit, and then if it should turn around, we want to have a buy order in place. Again, that would be, instead of $3 above the market where we're exiting, an entry point would be $6 above that predicted high to get into a long position. Not automatic. It just depends upon what the other indicators say, and kind of what's going on with the world in general as to what's going to happen with markets with the risk type of attitude that people have, whether they want to take risk or they do not. But let's get to something that's a little bit, maybe a little bit more widespread in terms of trading interest, and also in recent days pretty tricky. This is the E-mini. It's a 9-month contract. You can see that we have, just as we have in a lot of different markets, where you look at it and you see it in kind of in general, you'll say, well, there's a swing trading possibility there. Kind of went up. We're looking for these short-term swings up and down, and it depends, again, do you have enough to hang in there on the swings, or would you get out and then all of a sudden you break below there and you have a trending type move? Nobody's against a trending move. Fine, you just stick in, and the swing trade turns into that trend trade, and so much the better. Now, we'll assume that in this case, when you are looking at this market, we're going to kind of cut down our time frame here again, because in terms of where we're at today versus where we were at during some other types of market conditions, it's a little different. And so we're going to cut down, assuming that we might have gotten out somewhere in this time frame right in here, right in around August 9th or 11th of that trend where you had that steep drop. And of course, we know that you were on the right side of that when you were short, and you made a big profit there. So you want to, get rid of your positions in. The attitude of the market in general, and again, it depends a little bit on your perspective in terms of overall view of the markets, is that you have to pretty much say that overall the market is in a downtrend, and the pressure that you get from the upside is going to favor the short side. And the problem is that when you look at the short side and try to get a position there, you have these little bounces going back and forth. If you read David Colby on the TraderPlanet.com website, he talks about the possibilities of a small bounce, but about the most that you can expect, as he points out, is about a 3-day bounce in the current type of situation. And so we're not talking ideal swing trading type of conditions, but we'll try to, we can't dictate what it's going to be, so we'll just look at the markets with what we have and determine how we're going to handle it from here. Cut down our time frame down to just 2 months. Take a look at the 2-month range of the E-mini, and we're going to add our indicators into here. See what we're going to do. We're going to put the medium-term indicators in. We're going to do our predicted high, our predicted low, and we're going to add in the medium-term and long-term predicted difference and the neural index. We're going to throw the whole batch of indicators at you at once on the screen here, and try to determine what we're going to do, how we're going to handle the E-mini. The August 16th, going back into time, you can see that we had here a situation where the market had made its trend. It made its trend down, and as it made its trend to the downside, when you look at it, say, well, okay, are we in a situation where a bounce is going to suggest swing trading, or does that just kind of a little tiny little move, a little like David Colby suggests, a short-term indication of a 3-day bounce at the most, and like a flag formation that the trend then is going to go back to the downside. At this point, after the market has made that big decline that we saw in August and shot down, we don't know. We don't know if they're in a ongoing type move, but you got to say that at this point, if you were looking at it from an objective standpoint, that we are still looking to be short on any bounce or any kind of congestion area or recovery. So we're not into swing trading type mode yet, so we have to be prepared for the possibility that this market could go on lower, and continuing that trend mode as it has. So on August the 16th, the predicted low that we had was this one right up here. This predicted low that we had in here was, let's see here what we got, 1186. Again, I'm using rounded numbers here. I don't have the precise, quarters and all that kind of stuff for what the predicted highs and lows are. I'm using rounded numbers. 1186 was a predicted low. Because of the volatility that we had in August, and I want to make sure that we're talking a trend, if we're talking a trend, or a swing, if we're talking a swing. But so I'm going to use quite a wide latitude for my my average daily range. I'm going to say it's going to be 40 points in the E-mini, maybe a little wide, and obviously if you go back in history, it's probably a little wide, but we're using that because of recent volatility. So that means that from there you could sell at 1146, and if you sold at 1146, you'll see that you had kind of a sharp move to the downside here, and we're talking about somewhere right in this vicinity right here, 1146, where you would be selling 40 points below that highest predicted low that we have. In hindsight, you can see, well, that's not too good a place to enter. You know that we're coming back down towards where we hit those lows, and so the wisdom of doing that again will depend. If you look at it, we're going only here now for the short term type of situation. We'd like to be in a trend trade to the downside, and that's the mode that we're in. But we don't get it. We get a situation where the market starts to swing back up. A few days later, we get a predicted high at 1141, and so now we have to get that 1141 that we had. We are in a situation where the situations have started to change from that trending type of situation that we had. Not so obvious now that the market is going to continue all on down. So we're going to be looking